Understanding Open-End Funds, a comprehensive guide. When navigating the world of investments, many individuals encounter open-end funds. But what exactly are they, and how do they differ from other investment vehicles? This comprehensive guide will delve into the specifics of open-end funds, shedding light on their workings, advantages, disadvantages, and how they fit into an investor's portfolio. What is an open-end fund? An open-end fund is a type of investment vehicle that pools money from various investors to create a diversified portfolio. Unlike closed-end funds, open-end funds can issue an unlimited number of shares. They are primarily sold directly from the fund sponsor to investors and can be redeemed back to the fund at any time. The pricing mechanism is unique. Open-end funds operate on a daily basis with shares priced based on their net asset value, NAV, which is calculated at the end of each trading day. This pricing methodology guarantees that investors buy and sell shares at a price reflective of the fund's actual value, ensuring transparency and fairness. Most commonly, open-end funds manifest in the form of mutual funds and exchange-traded funds, ETFs, making them a staple in many investors' portfolios. They account for a significant portion of the investment options available in employer-sponsored retirement plans, like 401k plans, due to their accessibility and diversified approach. Key takeaways. Pooled investments. Open-end funds pool money from multiple investors, enabling a broad investment in various securities. Unlimited shares. They can issue as many shares as there are investors interested in buying. NAV pricing. Shares are priced daily based on their net asset value, ensuring investors buy at a fair market price. Liquidity and flexibility. Investors can purchase or redeem shares at any time based on demand. How does an open-end fund work? Open-end funds operate on a simple buy and sell mechanism. When there is demand for shares, the fund creates new shares to meet investor needs. Conversely, when investors redeem shares, the fund must issue cash, possibly by selling some of its assets. Daily valuation. At the end of each trading day, the fund's NAV is computed based on the underlying securities in its portfolio. This process involves 1. Valuation of assets. All securities held within the fund are evaluated based on current market prices. 2. Deducting liabilities. The fund's total liabilities, expenses, debts, are subtracted from the total value of assets. 3. Calculating per share value. The resulting NAV is then divided by the total number of shares outstanding to determine the price per share. Investment strategies. Investors in open-end funds can choose from various strategies targeting different sectors, asset classes, and investment goals, including growth funds, aiming for capital appreciation by investing primarily in stocks expected to grow at an above-average rate. Income funds, focusing on generating income through dividends, interest, and distributions. Sector funds, concentrating on specific industries, such as technology or healthcare. Regulating bodies and oversight. Open-end funds are heavily regulated to protect investors' interests. In the United States, entities like the Securities and Exchange Commission, SEC, oversee these funds to ensure compliance with laws aimed at preventing fraud and maintaining fair trading practices. Differences from closed-end funds. While both open-end and closed-end funds serve similar purposes of pooling investments, their operational characteristics significantly differ. Feature open-end funds. Closed-end funds. Issuance unlimited shares, finite shares through IPO. Pricing daily NAV pricing market price based on supply/demand. Trading not traded on exchanges, traded on exchanges like stocks. Investor redemption redeem shares directly from the fund, buy, sell shares through brokers. Cash reserves requirement must maintain cash for redemptions, no requirement for cash reserves. Closed-end funds may trade at a premium or discount to their NAV based on market conditions, making them potentially more lucrative but also more volatile. Pros and cons of open-end funds. Open-end funds have various advantages and some drawbacks, as outlined below. Advantages. 1. Diversification. Open-end funds reduce unsystematic risk by holding a diverse range of securities. 2. Professional management, managed by experienced portfolio managers who analyze market trends and securities. 3. Liquidity. Investors can buy or sell shares easily without waiting for a market to open. 4. Low minimum investments. Many open-end funds have low minimum investment thresholds, making them accessible. Disadvantages. 1. High cash reserves. To accommodate redemptions, funds may need to keep a portion of assets in cash or cash equivalents, potentially leading to lower yields. 2. Management fees. Actively managed funds typically charge higher fees due to higher operational costs. 3. Yield considerations. Open-end funds may sometimes provide lower yields compared to closed-end funds due to their conservative management of cash reserves. Real-world example, Fidelity's Magellan Fund. A classic example of an open-end fund is Fidelity's Magellan Fund, established in 1963. Famous for achieving significant capital appreciation, the fund gained fame in the 1970s and 1980s under the management of Peter Lynch, who became synonymous with superior stock selection. In its peak years, the fund's assets swelled to over $100 billion. Fidelity eventually closed the fund to new investors to maintain performance standards, reopening it almost a decade later. Conclusion. Open-end funds stand out as a highly favored investment option due to their flexibility, diversity, and practical approach to managing investments. They cater to a broad spectrum of investors, from novices to seasoned professionals, providing an effective way to gain exposure to various asset classes without requiring extensive knowledge. However, potential investors must weigh the benefits and drawbacks, as well as consider how these funds fit into their overall investment strategy. By understanding open-end funds and their unique features, investors can make informed decisions that align with their financial goals.